Hi guys, this is Siddhiams here from the team AOC. I just wanted to share a basic rundown of the way I trade. The fundamentals behind my trading style is trading ranges. According to me, price is always in a range. We can figure out where price is trapped and what is capping the market to the upside and what's holding it from continuing lower. Once we figure out what's the range in which the price is trading in, it becomes easier to trade. So a range can be on a 1 minute time frame. A range can be a 15 minute, 1 hour, 4 hour, daily or weekly. It can be a new range, it can be an old range, whatever the time frame may be and whatever the period of time. Price is always trading in a range. So how do we use that to our advantage? So my basic trading style has evolved from just range trading and using EMAs and other retail concepts to the smart money way of trading. But I still haven't let go of my core strategy, which is to trading ranges. So I won't focus on the smart money concept since AOC and Waffles are already going to share their thoughts on it, and you guys have already gone through the cohort, and some of you are part of the mastermind as well. So I'll just help you guys to include range trading as a part of your weaponry so that you can have a clear context of where price is and where price can likely go to. It's a pretty basic style of trading which can help even a novice guy. You don't need to know the smart money concept, you don't need to use 100 indicators. By just using this simple price action, you can definitely improve your trading win rates. So that is a basic introduction of trading ranges. Now let's start with how to set up your range. So I've already worked on Notion with step-by-step example guides for you, but I'll just do a basic rundown and I'll leave it for you guys to go through the material in detail and reach out to me for any doubts or feedback or whatever it is. So how do we start the process? We have to figure out what price level is capping the upside to the market. Once you figure that out, it is ideally feasible to wait for a break of structure on the lower time frame to confirm whether this is the range high or not. Since price also pulled back here and pulled back here, but there wasn't a break of structure. So once you can identify a break of structure on the lower time frame, the algorithm has chosen this price level as a key pivot. So that forms your range high. Yeah. So you don't know the complete range yet. So you wait for more price action to form. So till you find the range low, you are usually just watching the price action. So once price finds support at a key price level, so this can be a fair value cap, this can be a auto block, this can be a fib 618, whatever it is. We are not concerned about the smart money concepts here. We are just looking at what price level gave support, led to a break of structure on the lower time frame again. Once you have the range high and the range low in place, you can use the fib tool to mark out the 50% of the range. So that must be a pretty easy thing for you guys. So I wouldn't get into the details of how to set that up. Like once you have your range high, mid range, and your range low, you then wait for more price action to develop. Okay. And usually you short the range and you long the range low, and a mid range is for taking profits or hedging. If you think that price has a chance to continue lower, you don't want to sit in a trade and face drawdown, then you can hedge here. But that is usually recommended when the range is pretty wide. Say it's a $2,000 range, or if it's whatever, $5,000 range, or say like a 5%, 10% kind of a range. But if the range is too tight and you are not getting effective RR to hedge here, so just use it as a profit taking level and wait for more price action to develop. Yeah, so this is how you set up a range. I'll get into examples soon, which will give you clarity on how to go about it. But so how do we trade this? So let's get into the next. So usually what I do is I wait for the price to deviate from the range high or the range low. So once a range high and a range low is set, so there are stop losses here and there are stop losses here. So market makers, before choosing a direction from a consolidation, they are bound to take the stops of either the longs or the shorts. So I wait for price to deviate from either the range high or the range low. Is a time that I look for any trade. So here price found support on the mid range, found resistance on the range high. So people may have been shorting here, but then all the stops have been taken. Price looks like that is going to break out, but then it falls back inside and it finds a resistance on the range high. That is the time where I look for my shorts. Since the stop losses have been taken, there are trapped buyers here. There has been a break of structure and it has got back inside the range, showing weakness. And once it retests the range high clearly, that is a time where I look for my shorts, and my entry is around the range high. Stop loss can be here or here, depending on your risk tolerance. So once the trade is set, I usually take profit at the mid range, as I've told you before. And so price can deviate from the mid range and then try to hold back, fill the imbalances here. That is a place where I can hedge along if the range is wide enough and lock in a bunch of profits and then close the trade quickly, because this is more or less going to be a scalp. So the mid range level is for scalping only. So once price gets back to range low, that is where I close my trade. Yeah, so the trade may break down, so I leave some 25% still in the trade, but most of my profits I lock in here and I wait for the same sort of a deviation to form again. So the same concept is here, that there are trapped sellers here. Stops of longs have been taken. So that is where market maker enters. And I again wait for more consolidation and a break of structure and price to get back inside the range again. Once I have clarity on the lower time frame that price is showing some bullishness, that is where I fire my longs and my take profit one is here and I leave the rest right to range high. So that's the basis of my trade. I can trade these pivots also, but I usually wait for deviation because then it becomes a higher probability trade. So yeah, so that is how you can trade a range. Moving on to the next part. Yeah, so this is where it becomes tricky. How do you differentiate between a range breakout and a range deviation? Once price leaves the range and takes the stops of this high, does it still consolidate on top of a range, or does it continue by breaking this high set? If there is a break of structure after sweeping the high, that shows strength and a higher probability of continuation to the upside. So that is where I can enter longs or I can add to my positions which I'm in from here. So if I close 75% of my position here, once I get the required confirmation, I can always step back into the trade with my stop loss being here or here. Yeah, so that depends on the price action, and the same thing is applicable here. If I close my shorts here and price chops around the range low, but when it breaks structure after the sweep, shows clear indication with volume that price is going to continue downside, that is where you can re-enter again. So that is how you trade range breakouts. So the advantage of this style is that you will already be in shorts. If we are breaking down to the downside, you may have locked some profit, so your trade is safe and in profits already. Plus you can add to your position after more confirmations. So yeah, so your average entry price might come down when you compound your entry, but this gives you more surety of a continuation to the downside. So you can go with a larger position. The same is the case for this. I will be in long from here already, and after confirmation, then I can add more to my position. Yeah, so I have broken it down, my thoughts and the processes on these charts. So you can go through it in detail if you have any trouble understanding till now. Yeah, so there are times where the range is pretty wide or long, or the consolidation or the job is for a pretty long time. Usually denotes that a bigger move is coming. So like basically, the longer the range, the bigger the expansion will. So what happens in a longer range like this is that the price tends to create equal highs and equal lows to engineer liquidity. Since a bigger move has to be followed through after a range breakout, so market makers need to engineer liquidity on a larger scale, since they have to fill their bulk orders, and just say like spending like 10 days in a range won't be enough for them to be profitable. So that is why they spend more time in the range and they stop everyone out, and when people have given up and have switched sides, that is when the actual move happens. So yeah, so the whole thought process has been given here in detail for you to know my thought process. But basically, equal highs are set for people to put their stop losses, and the same is the case here. So once your stop loss for a short hits, it becomes a buy order. And the buy order is then used by the market makers to open their sell orders. Because if you are buying, then someone has to sell. And if you are selling, someone has to buy. So market maker fulfills that obligation to have an order against your own order. Yeah. So the ratio always has to be 1:1. So that is why they keep on going for stops, because stop losses is a buy order, since you have to buy back your short position. And the same is the case here, that your long order, when you get stopped out, then it becomes a sell order. So then they buy your position. So that is why using smart money concepts like this, you tend to wait for the equal highs and lows to be swept before entering into a trade, because that adds more confluence to your trade, and also you are trading in the direction of the market. So yeah, so like basically people who are short have been stopped out, they might switch bias thinking that we are breaking out, and yeah, so then more buy orders are placed here, and market makers then sell against you. The same case happened here. People are thinking that it's a breakdown, plus all the longs have been stopped out. So those are sell orders which are bought by the market makers, and then they switch direction basis all the liquidity that has been engineered here. So yeah, so the range breakout model which I shared earlier like still stands here, but yeah, like this is how basically you can trade ranges, and why you should only trade the deviations and after taking highs and lows. So trade only deviations after confirmation. Yeah. So the confirmation I've shared earlier, price needs to get back inside range. There needs to be break of structure. You can add more confluence with say an RSI and things like that. But I'm not getting into detail right now. And that is why it is always important to take profit at the middle. Since if you were in shorts here, and you would have taken some profits here in your stop side here, so your trade is already locked in profits. And when you take profits, you need to move your stops to break even. So your trade doesn't end up being a loss. To add more granularity to the range, you can add two more levels. So this becomes the range high, range low, mid range, and these are quarter ranges. So when the range is pretty wide, and yeah, so price may chop inside this quarter for a few hours or days. So then you would be stuck waiting for a mid range trade or a range high trade. So that is why you can divide it into each section of 25% and trade from there. So basically, the fib setting tools I've shared below. So this is the fib setting tool. It's like pretty simple. 0, 1, 75, 25, and 5. Like once you find the range high and the range low, you can just plot this range. So I'll just go to one example and then I'll leave it guys up to you, because I'm not getting into full detail in this brief introduction. And there was a range high which led to a break of structure here. That is why this we consider as a range high. And here we found support, and there was a lower time frame break of structure here, as you can see. Once we had the range high and the range low set, you can see mid range came as resist. You could have shorted this as well, since the range was pretty wide. And for higher probability trades, we wait for deviation. So what deviation happens here? Sweeps the low and it forms a tree drives bullish pattern, and then we get a move to range high. So the first tap was this order block, which led to a move to mid range. But you see that the second bounce was a bit smaller. So it took liquidity from here. It only bounced to the mid range, since the liquidity wasn't there for the move to range high. Once the lows have been swept multiple times and people have gotten bearish now, we are breaking down again, which was basically a fill of this fair value gap here. But the retail doesn't understand that. And this sort of a price action, they will go short when this breakdown happens. Plus, there was a closing candle here which looked pretty bearish. Yeah. So leaving all of those aside, if you would have seen the price action on the lower time frame, you would have waited for the price to reclaim this range low, and that was your long. Your stops would have been here, and target would have been mid range and range high, and you could have taken some profits at the 25 and the 75% level as well. So the same thing happened here at the range high. Price broke out. People are longing the shit out of it, but there wasn't a continuation. Price came back inside the range, and you could have gotten your entry here on the lower time frame for a scalp to the 75% level. So once price again reclaimed this level, you could have longed here with your take profits here. And since the market structure had flipped bearish, so your bias was shorts again. So you wait for a second round of deviation, and you wait for price to get back inside and get a proper retest. So this would have been your swing shot. Swing to like basically mid range. Yeah. So like that is why you take profits at the mid range and then set your stops to break it. So you found support at the mid range, and then again you went for the range high. But here there are a bunch of equal highs left. So your bias is to wait for a sweep of these highs and a sweep of this high as well, since there are stops resting here. So once all the highs have been swept and price broke down inside the range, so that would have been your short. Yeah, but this candle would have been very difficult to predict. So you could have taken a level to level trade from this level. And when you saw that price is finding support here, then you could have traded here. But this imbalance also needed to be filled. So you got a retest of the range high and price failed to reclaim it again. So that's a clear sign of bearishness. And you can see multiple sweeps, one sweep, two sweep, three sweep, four sweep. Once so many sweeps are happening, which was the same case here. This was the bullish tree dive. This is the bearish tree dive, or looks like four drive. So you could have waited for the price to close back inside, and that would have been your short to range low. So usually the first time you short it from range high, a mid range acts as support, but then it tends to lose its strength, and slowly you can see that the price is trying to roll over. You can see like a rounded top forming here. Then the price is looking for lower levels to seek liquidity. You can see the range look again gave us some support, but once we get a clear breakdown here, which is a break of this with candle closure, so you could have shorted the gap fill of this fair value gap here. Since this is chop and you should stay away from the chop, once you get a clear breakdown, you are bound to get a retest or a pullback to a fair value gap or an order block or your fib level, whatever it is, and that is the time that you can short this. Same was the case here. If we would have gotten a continuation from here, that was a time to flip long, but we did not get that since we formed the lower high after that. So then it all trickled down. I'm sure you guys remember this Wyckoff range, which was popular during March, April last year. And if we knew the range trading concept, then how many trades would you have taken? Yeah. So this is kind of a summary of my range trading. Hope it was useful. Cheers. Bye.